Hi, and welcome to Jan Scott on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to demystify hedge accounting so that you don't have to be afraid of it anymore. And we will find that at its core, there's actually a fairly noble idea in hedge accounting. And knowing about these principles help us understand and manage financials. So for the full discussion and many examples on hedge accounting, please consult my book, Corporate Foreign Exchange Risk Management, co-authored with Alf Alviniusen and Lars Oxelheim. There's also more information on my website, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. All right, so starting with a very basic observation here that hedge accounting is a way to account for derivatives. It's a set of principles for how that can be done. How we can show these derivatives in the financial statements. So there has to be some principles to guide that, right? And in the principles underpinning hedge accounting are different then from the standard way, which is fair value accounting. So this is how derivatives are normally supposed to be accounted for in the financial statement. So we have one set of principles that, unless you apply hedge accounting, will dictate how you're supposed to present these derivative instruments in your financial statements. All right. So this means we have to understand fair value accounting then, how that works, and what the problem might be with that could motivate something like hedge accounting. So in fair value accounting, derivatives are carried in the balance sheet at their estimated fair value, meaning that we're supposed to come up with a valuation of our portfolio of financial derivatives in each quarter and show that as an asset in the balance sheet if it's of a positive value, and we show it as a liability in the balance sheet if it's a negative value. So whereas the changes in this portfolio, or in the fair value, I should say rather, of this portfolio is reported as a gain or loss in the income statement. So in the eyes of accountants, it's a loss if there's a decrease in the fair value, and there's a gain if the fair value of the portfolio of derivatives goes up. All right, so that's how you take care of derivatives in the normal case. So we're going to introduce some terminology here to keep things reasonably short. So FVA is fair value accounting, GL as gains or losses, AL is our assets and liabilities. So pardon me for all the acronyms here, but all right. So fair value accounting then, let's say we enter a derivative contract at time 0 today, and that will have a net present value then of 0 if we assume that derivatives are fairly priced. We're entering a fairly priced derivative contract here, so that starting out there will be a 0 value. It's neither a loss nor a gain initially, right? So we're getting a fair bargain. Then market rates changed. So before we reach the next quarter end, which is here, right? So in this case, the change was such that the derivatives now have a positive value. So you've made a gain. So, but first of all, you quantify the fair value of this portfolio, right? And in the next step, you take the change and put that in the net income statement, because that's the basic principle here, right? So this difference between 0 and 25 goes into net income. You have to show it there as a gain in this case, right? It's a positive number. So, but let's say we roll this over another quarter so that at this quarter's end, it's down into 7. It's still a positive number, so it's still an asset in the balance sheet, right? But it's a lower number, so there's been a decrease between these two quarters, and we have to show that as a loss, because it's coming down from a larger positive number to a lower one implies a loss. That's how this works. So we show that as minus 18, and this just repeats itself, this process, right? So here we move from 7 to minus 2. That implies a 9 loss. So whenever there's a change in the derivative fair value, then that has to be reported as a gain or loss. And this is what some managers are not too fond of, to put it that way. They find this to be annoying and some problem, that you have to report fair value gains and losses in the net income statement. And it happens because the business transaction that they hedge is not allowed to be fair value accounted. Right, so you have two different set of accounting principles involved here. You can apply fair value account, or must apply fair value accounting to the derivatives, whereas you're not allowed to do that for the very transaction that you tried to hedge. Right? So, and that creates a mismatch then. And because of it, there is more noise. There's going to be more fluctuations in net income, making it more volatile. Whereas you, by hedging, you're trying to reduce volatility and make your bottom lines more stable, right? And that's where hedge accounting actually offers a solution to this. You can, if you apply for hedge accounting, you can make the financial statements appear so that these GMLs, gains and losses, are kept out of net income. So you avoid this volatility in net income. So, and that's a fairly noble thing, right? We're trying to restore, the matching principle here, so that the hedged item and the hedge follow the same kind of principles, and you don't have to experience excessive noise in your financial statements as a result of trying to achieve a cash flow hedge, right? Because of that's what we ultimately are trying to do. We're trying to hedge a business transaction to stabilize performance, but we get this interim volatility as a result. So hence hedge accounting. That's what we're trying to solve here. All right, so let's take a euro-based firm now, expecting a receivable in pounds 6 months from now, and that will be June 30, right? So we're January 1st and looking ahead here. So we decide to sell forward this amount at the available forward rate between the euro and the British pound. Then. So we can lock in the forward rate at 1.4. So from a cash flow point of view, this makes sense, right? Where we expect a receivable to come due on exactly that date. So we sell forward currency for that date as well, so that they match, and you pretty much get rid of FX exchange rate induced volatility from that foreign denominated receivable, right? So from a strictly economic point of view, it's an effective hedge, right? You achieve your objective, which is to get rid of the impact of market risk on your business transaction in the receivable. But okay, so let's see here what happens then in the next quarter, in between. Like we have to close the book on March 31 here at the end of quarter one, and let's say there's been a change here in the exchange rate, so that's now 135, and that's a weaker pound. It takes fewer euros to buy £1, so that is bad from a business point of view because the receivable is now worth less, right? So that must be a gain on the derivative because the derivative is designed to offset any losses on the business transaction. But this gain here on the FX derivative has to be reported in the financial accounts according to standard fair value accounting. But there is no corresponding entry for the fair value change in the business transaction. So what have we then? Well, there's a unrealized gain then of 4.5 million. That's the assumed number here that because of the change in the exchange rate, we're seeing a gain here. It's unrealized at this point. We haven't sort of cash settled the transaction, and so it will appear in the balance sheet as an asset because the unrealized effect is a gain here. Still nothing on cash. That's doesn't get impacted until settlement, right? And the loss, sorry, the gain showed here in net income finds its way into retained earnings, right? Because that's where they accumulate. And this is volatility. In a number of places, there are now numbers being reported, but there's no corresponding entries for the business transaction. So this is adding to volatility. It's making it more volatile. And this was not the intention with the hedge. The hedge was designed to take care of markets, the impact of market risk at maturity, right, of the contract when it's cash settled. So this is an unfortunate side effect of what is economically speaking properly designed hedge, right? So with hedge accounting, we can keep unrealized gains and losses out of net income. That's the promise of hedge accounting. And so what happens then, we're going to put them in a new or a different equity account, which is referred to as hedging reserves. So it sits in shareholders' equity alongside retained earnings, in the same sort of set of lines there in shareholders' equity, but it's not retained earnings that is going to be impacted. And the unrealized gain and loss itself goes into other comprehensive income, which is an income statement, but it's not net income. So this is one of the peculiar things about financial statements, right? That you don't have just these net income, cash flow statement, and balance sheet that we're normally dealing with. That's where most of our attention goes, right? And many people don't even see that just below net income there sits another smaller income statement referred to as other comprehensive income. So that if you put that together, you have total income. Net income plus other comprehensive income is total income. And here's the thing, the other comprehensive income is pretty much there to absorb all of these translation gains and losses that occur in various places in the financial statements, not only related to derivatives, but currency gains and losses and other revaluation effects, that just occur more or less for technical reasons, and we're trying to avoid that, or I guess that's the intention of the rule setters, to allow firms to keep most of that out of net income. So it goes into this other comprehensive income. So that is what we're going to use now. This is the mechanism. We're going to use other comprehensive income and the hedging reserve instead. So now that you're applying hedge accounting, you're actually allowed to show it on a different set of lines. Then. This unrealized derivative gain loss goes into here. So net income is now clean, free of these derivative fair value gains and losses. And instead of reporting the accumulated gain and losses here, this is the line we're using. We're storing them in the hedging reserve. So it goes there. So it's kind of peculiar. You're just using two different lines here, but the goal is achieved. There's no volatility in net income or return, and that was the purpose of it all. So, well, again, you might wonder, why this is such an improvement, but the net income is the core bottom line for many firms, right? That's where you have most of the attention, and that's what they're trying to manage and maximize. And if that is your bottom line, well, then it makes sense to manage it and try to keep it tidy and free from unwanted noise. So it becomes, for more or less psychological reasons, feels better to have them out of net income, but it could be, if you're a tiny bit cynical, you could argue that in some cases it's related to compensation plans. So it's a multifaceted concept to understand why firms do hedge accounting, but we'll save that discussion for later. So here's what it looks like then. Compare the case of hedge accounting, where there is the numbers are appearing in these two accounts now, hedging reserve and unrealized gains and losses. No volatility here in net income. Here in this, this is Q1, March 31 we're talking about here, so still not realized. All right, so whereas here, there is volatility in net income and retained earnings. In the case of no hedge accounting, right? So just as we saw. When we arrive at June 30, you know, and the hedge is derivative is cash settled and the underlying business transaction. Well, what happens is that if we take the case of no hedge accounting, well, you got volatility here, we just saw that, but you get volatility here as well, more volatility, because now you have a derivative cash flow which coincides with the business transaction. So that is actually hedged and you stabilize that. But you don't have gain or loss in the net income statement to show for it. So they don't coincide anymore. You're having added volatility there as well. Whereas here, there's no volatility on Q1. Nothing happens here in net income. Here, the derivative cash flow coincides with the income as you reported in the income statement, right? And this now coincides with the business transaction. So it's the timing and the matching principle is restored. So mission accomplished there. So net income is less volatile in both periods. The derivative gain and loss coincide with the derivative cash flow, and the matching principle is restored. So, all right, so to sum up the whole thing, derivatives are fair value accounted, but not the business transaction they hedge. So there's a mismatch creating volatility in net income. The job of hedge accounting is to do something about that. You know, we improve the matching by storing the unrealized gains and losses in a hedging reserve, and it's released back into net income when the contract is settled. So the ultimate effect on cash flow, cash and equity are always the same. What's avoided is basically the net income volatility of the derivative's lifespan. So that concludes. All right, thanks for listening. You'll find more reading on this in my book, Corporate Foreign Exchange Risk Management, Empowered Enterprise Risk Management, also, riskbudgeting.se for more information. Please like and subscribe. Have a good day.